So here in question 6, first thing we're asked to do is make a bunch of journal entries. And so this will be a good review of the journal entries that you learned in chapter 6, which will be on the exam. And so the company made a number of sales in September, October, and November. And because this company uses the perpetual inventory system, that means you have to make 2 journal entries for every sale, one to record the sales revenue, and one to record the cost of sale. And so you're given all that information and you go ahead and make all those entries. The very last entry in December is to record the receipt of cash from one of the customers that you sold to back in September. And so, of course, we debit cash, credit accounts receivable for a transaction like that. So then in requirement 2, we're going to use the aging of accounts receivable method to estimate the future bad debts. And so the more past due a debt is, the higher a percentage we're going to use to estimate uncollectible accounts. And we're given the percentages here. And so we're going to leave this 1 month cell blank because we didn't make any sales in December, so we have nothing in December to multiply by. But we did make sales in November, so those sales would be 2 months ago since we're doing this as of the end of December. And so we would take the $280 sale in November and multiply by the 5% rate to get 14 as our estimated uncollectible amount. Then the 3-month percentage is 20%. We'll multiply that by the $430 sale in October. And then finally, the 40% uncollectible estimate for sales more than 3 months ago, that's going to be the sale that we made in September. However, remember, the sale was for $1,750 and they paid us $1,170 here in December. So it's just the difference, just the amount they still owe us that will multiply by the 40%. Then when we're all done, we just add these amounts up and put the total here. Now in requirement 3, this is where we are making our adjusting entry to adjust the allowance account. And so we're also told there's a $46 credit balance in the allowance account before we make this adjusting entry. So we already have $46 in credit in there. We want the account to have a credit balance of $332 with my numbers here. So that means we just need to put the difference in. So with this extra credit to the allowance account and with the $46 credit balance that it already had before the adjusting entry, we're going to end up having an ending credit balance equal to $332. And that's what we want the ending credit balance to be heading into the next year to absorb these estimated future bad debts. Then in requirement 4, we're asked to calculate the accounts receivable turnover ratio. That formula is net credit sales divided by average net accounts receivable. Well, we're given net accounts receivable at the end of last year. That's going to be our beginning net accounts receivable balance this year. And what we need to do is add that to the ending net accounts receivable balance this year, and then divide by 2 to get the average. So the ending net accounts receivable balance this year is going to be total accounts receivable as of the end of this year. And we can figure that out by going back to our journal entries. So here's one debit to accounts receivable. Here's another. So let's add these debits together. Add this third debit. And then finally subtract this credit. That's going to give us our ending total accounts receivable balance. Then what we need to do is subtract the ending balance in the allowance account, which we know is going to be equal to this number, because after we post this credit to the allowance account, we're going to end up with this ending credit balance, because remember, the allowance account had a $46 credit balance to begin with. So 46 plus 286 is going to equal 332 for the ending balance in the allowance account as of the end of this year. So finally, and we can see these calculations down here, once we have our ending net accounts receivable balance, we'll add it to the beginning net accounts receivable balance, and that was given to us in the problem. Divide by 2 to get the average, put that answer in the denominator, and then complete this formula to get the accounts receivable turnover ratio. And then very last requirement is just asking about whether Audrey's Mineral Spa, that's a competitor, it has an accounts receivable turnover ratio of 8. So how does ours, and we are Nicole's Getaway Spa, how does ours compare to this competitor's? Well, ours is better because with the accounts receivable turnover ratio, a higher number indicates we are collecting faster on our receivables. And so since ours is higher than our competitors, then we're doing a better job. We're collecting our receivables faster.